Welcome, everyone, and thank you for joining Treasury Strategies' quarterly cash briefing webinar. Each day seems to bring a new twist and turn for corporate treasurers and bankers, and today we're going to examine some macro factors and the decisions the corporate treasurers and bankers need to make to deal with our changing economic policies, the regulatory environment, market dynamics, and geopolitical events, just to name a few of the items we're going to be discussing today. I'm Tony Carfang, and I'm a partner with Treasury Strategies. As you know, Treasury Strategies consults with corporate treasurers and financial institutions on treasury, payment, and liquidity issues. I'm joined today by my Treasury Strategies colleague, Kevin Ruiz, and three distinguished panelists, Susan Hill from Federated Investors, Peter Matza from the Association of Corporate Treasurers, and Roger Merritt from Fitch Ratings. Today is a special day. Today is the day that another round of money market fund regulations go into effect in the U.S. These are the disclosure requirements, and we're precisely 6 months from the day when the remaining money fund regulations go into effect. In addition, yesterday we saw something significant happen in Washington, D.C. in terms of the Dodd-Frank regulation, where the House Financial Services Committee actually voted to end the bank bailout fund and to place the Consumer Finance Protection Bureau on a spending budget. Now, that's largely symbolic, but we find that very interesting. Today, we're going to be discussing that and other issues. Now, as a quick aside, everyone who's registered for this session, in a day or two, you'll all receive a copy of the presentation and a link to a recording on Treasury Strategies' YouTube channel. And on that channel, you'll find not only our cash briefing recordings, but many helpful short recordings, 5, 10, 15, 20 minutes on specific Treasury and banking topics. Just go to YouTube and search Treasury Strategies. We should be at the top of the list. Should you wish to ask any questions, you can do so in the box at the bottom right-hand corner of your screen, and we'll handle these questions offline after the webinar is done. So now, turning to our agenda, I will be speaking for a few minutes to update you on the changes in corporate cash levels around the globe. Following that, Kevin Ruiz will be sharing with you some of the findings of Treasury Strategies' recent State of the Treasury Profession survey, where we've talked to a couple of hundred treasurers among our client base to find out what their key priorities are over the rest of the year and into 2017. Then we're going to move to our panel and discuss the changes in economic policies, regulations, market dynamics, and the geopolitical environment. So sit back and enjoy the rest of the session. So moving to corporate cash levels, and if you see the chart that should be familiar to you now, what we see is corporate cash continues to increase, and this time in every single jurisdiction around the globe that we examine here on this chart. In the U.S., corporate cash was up 2.4% just in the last quarter. In the UK, it was up 3%. In the EU, it was up 1.1%, and in Japan, up 1.25%. Now, what we find particularly interesting about this, in addition to the continuing upward trend, is that in the U.S. and in the UK, quantitative easing ended a couple of quarters ago, or several quarters ago, actually. Yet corporate cash continues to rise, which kind of sort of disqualifies the hypothesis that says the corporate cash is rising because the central banks have been pumping money, too much money, into the economy, and some of that's ending up on corporate balance sheets. At Treasury Strategies, as we work with our clients, what we see is most of our corporate treasurers are increasing the level of precautionary cash that they're holding on their balance sheet. In some cases, it's because they're uncertain that their banks will continue to provide the level of funding and credit because of changes in Basel III that are just now being implemented. In other cases, they're concerned that money market funds will have fewer assets available to invest in the private economy rather than in the government sector. and therefore they need more precautionary cash. And then finally, because of the Volcker rule, they're actually concerned about the levels of liquidity in the marketplace. So there are a lot of concerns here that we think are driving up the levels of corporate cash. Now, on the next slide, what we see is a long-term trend line here, and in fact, the trend is getting even tighter. If you look at the R squares, which actually shows the degree of fit in the trend line, these are all up from last quarter. And so what that tells us is, as time has gone on, the corporate treasury behavior and the directionality really has not changed. Companies are simply holding more cash. Now, if we look at this relative to GDP on the next slide, we see that in the U.S., corporate cash is equal to 11% of GDP, in the Eurozone 22, UK 33, and Japan 52. Now, those are all up quite a bit from the year 2000 when we began computing this time series. It's interesting that even in the last quarter, Japan and the UK are each up 1 point, and that tells us that if cash is accumulating faster than GDP is growing, capital is being moved to the sidelines and withdrawn from the real economy, which is obviously problematic, at least from a macroeconomic point of view. Now, moving on and looking at the actual regressions in terms of cash relative to GDP, again, we see extremely tight trend lines, all positive, by the way. So as GDP grows, cash is growing. You see the degree of fit there, the R squares in the mid to high 90s. It's just incredible. Japan is moving in the other direction, and as we've stated before, it's not quite clear whether the Japanese economy is sort of where the traditional economic rules are still working in Japan. They may have crossed a tipping point into some new territory. If any of you have any hypotheses about that, please let us know. Now, on the next chart, we look at some of the behavior of central banks. And if we look at the reserve balances and prior to the financial crisis, reserve balances held by banks by commercial banks at the central banks were de minimis, very, very close to zero, and they all spiked up right at the time of the financial crisis. We see, though, in the U.S. and in the U.K., reserve balances actually declining. In the U.S., to the extent of about $300 billion, and in the U.K., in excess of 30 billion pounds. So we're seeing a change of trend there. Yet in the the Eurozone, and in Japan, those numbers continue to rise. Now, obviously, that's a concern for corporate treasurers, because these will impact capital flows and exchange rates, and could conceivably also contribute to the levels of volatility in the market. The final slide I'd like to share with you in our statistical recap this morning is the central bank assets by GDP across the various regions, and a couple of interesting things to note here. So the U.S. and the U.K. have been flat now for several quarters, in fact, going on 2 or more years, at about 25% of GDP. That is, the central banks are as large as 1/4 of the GDP. The good news is it's flat. The bad news is, though, it's still 4 times higher than the level in those 2 jurisdictions prior to the financial crisis. So clearly, the central banks are playing an outsized role in the economic system. In Europe, what you see is the up and down there. Europe is back to 25%, the same as the U.S. and the U.K., but down from its high of 32% a couple of years ago. So we'll be watching to see where that goes. And Japan continues to rise. So those are the financial statistics. Let me now turn the chair over to Kevin Ruiz from Treasury Strategies, who will talk about our direct experience in consulting with corporate treasurers and their response to our State of the Profession survey. Kevin?
Thanks, Tony. As Tony mentioned, what we want to talk about today is really understanding what trends we're seeing here at Treasury Strategies with our corporate treasury clients. And what our panel is going to discuss today is kind of what's driving some of those priorities and some of those issues here. So as many of you know, for the past 10 years or so, Treasury Strategies has conducted an annual State of the Treasury Profession, where we survey our corporate treasury clients and peers to identify all the different trends and the issues, the challenges, and really the headaches that our corporate treasury peers are facing. This year, we saw the following trends that you see in the slide that we're looking at here. Cash forecasting has gone up significantly, as well as some other issues around risk, FX management, leading practices for treasury operations, relationships with banks, and really the TMS systems have been something that's become more and more frequent in terms of questions and then requests for assistance that we've provided with our corporate treasury clients. Now, moving to the next slide, there's been some big changes in terms of what we're hearing, frequently from year to year. We see an increase in requests for more information and assistance in banking services, a big increase in cybersecurity, which personally I didn't think we were going to see as big an increase as we saw last year, but it's gotten even more top of mind with our corporate treasury clients. Balance sheet optimization and questions around how to do that have become more important to our corporate treasury clients in the last 12 months, as well as investment questions, and then external reporting, not just to the regulators, but also to shareholders, stakeholders, and other interested parties. Now, looking at the next slide, to contrast that from what we heard in the State of Treasury practice, this is some of the main things that we've seen here at Treasury Strategies in the last year. Cash visibility and cash forecasting have become extremely frequent questions and frequent requests for assistance from our corporate treasury clients. That's become a big issue for our client base in the last 12 months or so. FX risk management, FX strategy, not just understanding what the FX exposure is, but how to address that, how to put in hedging strategies and all those fun things. Extremely frequent requests for that. And then requests for assistance on selection, implementation, and now we're seeing a lot of requests around optimization of our clients' treasury management systems, both hosted systems as well as SaaS systems. We've seen a lot of requests around that. Banking and liquidity management, RFP assistance, which is something that we've always done a lot of. We're seeing more and more of that this year as well. And then finally, assistance with understanding and really implementing treasury operations and what we consider to be leading practices for that. We're seeing a lot of that. So, Tony, I'm going to turn it back to you, and I'm going to let you bring in Peter and Roger and Susan into this discussion, really. What do you think is driving some of these trends with our corporate treasurers?
Well, thank you, Kevin, for that overview. And as you all hear there, our clients have a lot of issues on their mind, which is why we bring together such an august panel. Susan Hill of Federated Investors, Peter Matza of the Association of Corporate Treasurers, Roger Merritt from Fitch Ratings, and Kevin Ruiz from Treasury Strategies will be participating in the panel. And what we've decided to do today, rather than talk about specific game changers as we have in the past, is to lay out sort of 4 general areas of discussing: policy, market dynamics, regulatory changes, and the geopolitical environment, and have more of a ranging discussion on each of those. I think since I mentioned earlier that this is a big day for the U.S. money fund industry, why don't we start in the top right box with the regulatory changes. Sue, could you tell us what's actually being enacted today and how that impacts our listeners?
I would be happy to, Tony. Good day, everybody. So today's a big day, as was mentioned, from a disclosure perspective for money market funds. It's the day that fund companies need to disclose for all money market funds 6 months of history of daily information. That information includes the daily and weekly liquidity positions for funds, percentages for funds, the shadow net asset value on a daily basis for portfolios, and then also on a daily basis, net shareholder flows. So we need to show 6 months of history, and then from this point on a daily basis, disclose all of those metrics. I think it's a big step from our standpoint. I think from the industry, obviously, is approaching the October 14th deadline fairly quickly. And investors in our products are struggling to, make final decisions about what alternatives that they're comfortable with. And in order to do that, many of them can now use the information that will be publicly available to them. They can look historically to see what typical, if fees and gates are their issue, what typical daily and weekly liquidity percentages look like for any given portfolio or portfolio type. Or again, if the floating NAV is one of their big hurdles, then they can look to see how in certain rate environments, one that included a Fed rate hike, how the shadow NAV of money market funds have behaved over this time period. So we're hoping it gives investors the tools to come to final decisions about their investment options and gives them some comfort in that process.
Well, Roger, you oversee Fitch Ratings' money market fund business. What implications do you see for money funds, first of today's changes, and then preparation for 6 months out?
Sure, Tony. Well, it's certainly a sea change for the industry, and I think it's going to have far-reaching implications. I think the changes today that Sue announced, are going to give really an unprecedented level of transparency into the shadow NAVs of these funds, how much weekly liquidity they hold, and net inflows or outflows. And I think liquidity in particular is going to be top of mind for investors as we approach October, particularly for funds that may face the prospect of at least the possibility of having to impose fees and/or redemption fees and/or gates in the event liquidity falls below weekly liquidity falls below 30%. So I think that's probably going to be the most important implication, and that means that funds are probably going to have to manage, more conservatively than they have in the past. We're already seeing that. Money funds are building liquidity as we go into the summer. On average, north of 40% for prime money market funds in terms of weekly liquidity, and I suspect that will continue to grow. So that to us is the key implication.
Thank you. Now, Peter, the European regulators have been moving on the money fund issue as well, but at a different pace. Could you update us on where that stands and what kind of behaviors you're seeing there in the UK and in Europe?
I'm not sure I have latest detail on exactly where they have got to. Sorry, I should have said good afternoon or good morning, everyone. What we do know is that our members and the corporate treasurers we talk to in the UK and across continental Europe are still comfortable users of the product and of the marketplace. I was listening with interest there to what Susan and Roger were talking about, and maybe with my devil's advocate hat on, I'm wondering whether anyone who's going to be getting the volume of information that's going to be coming out is really, other than an institutional professional, is really going to be capable of deciphering and discerning how much or valuable that information is to them when they're making a decision between this given AAA money market fund or that given AAA money market fund. I wonder also about the regulatory stance on that and whether their skills are sufficient for that purpose. So that would be true across the board for a number of regulatory issues, not nearly those in money market funds. But we're not seeing any, by contrast, we're not seeing any great movement away from those people who are users of money market funds towards the repo market for similar sorts of reasons, or rather for the sorts of reasons that we've been hearing for a little while, which is it's still complicated to use it, there are still issues with paperwork, there are still issues with how you manage to record that and how you sell that internally, if only to your own management, let alone other stakeholders. So I think from that point of view, while the European regulators are moving more slowly, they have taken on board, I think, some of the considerations that we and others have put in front of them to an extent, and I think some of the heat's gone out of some of the difficult debate of 2 or 3 years ago, but I'm not yet confident or comfortable enough to say they've reached a final point or position as to what they're going to be doing in terms of money market funds. We certainly have not been involved in any responses, or there have not been any further public consultations that we've been involved in for, well, I'm guessing at least 9 months to a year now, so it may well be that they're sitting on that. In fact, what has come out is a much broader European Commission on the regulatory framework for financial services and various things where we have commented upon a whole range of regulations they've put in, including the money market funds ones, and basically said you might need to take stock, sit down for a little while, think about where you're trying to go with this, and make sure that they're all interlinked. Because otherwise corporates will have nowhere to put their money, let alone what they're doing in banking sectors with ring fencing or whatever it may happen to be. I realise that's not a complete answer for you, Tony, but that's probably about as far as I can go at the moment.
Well, I'll tell you, that's more complete than most commentators can give on the topic, Peter. And you know, it's interesting. You alluded to the fact that there are complexities in investing in other money market instruments, and that the funds represent an ease of trading and sort of an ease of investing in a diversified portfolio, so that they do retain their luster, even though some of the proposed regulations sort of nibble at some of that.
I would say that's probably true, if I may interrupt. I would say that's probably true. I'd also add that some of the changes, and in particular, not just people like Federated, but some of the other leading fund houses, in terms of making information more available, in terms of allowing some look-through into the underlying portfolios and so on, has certainly helped people have that confidence to say, well, this is a product we understand, this is a tool we understand, and all other things being equal, it's not something we necessarily want to go away from in a hurry, because it offers us the things that they want, even if the returns on them aren't that great. They are, at least for the most part, positive, and they are, at least for the most part, liquid. So that allows people to at least say, well, I can get rid of that problem, I can think about something else for the time being. Clearly, though, if we're all piling up yet more money, we're going to have to find yet more places for it to go. Very good. Now, Sue, you talked about all of the new data that would be available, and Roger mentioned how interesting it would be to look at that, how important it is, and Peter questioned whether or not, you know, someone sitting in their office with a full-time job to do can really look at all this stuff. At Treasury Strategies, we actually expect you to start seeing, literally within days of this, money fund portals announcing new products or new product features that will actually absorb this data for corporate treasurers in the portal and digest that and actually make that manageable for corporate treasurers. So I would expect to see a number of product announcements within days, if not today, as a matter of fact. I think everyone's been actually waiting for this. Now, other regulatory changes, just very quickly, we see Basel III, Dodd-Frank, and we're hearing from our corporate clients, and perhaps Kevin, let me ask you to chime in on this. Mm-hmm. How do you see our corporate clients thinking about
Basel III and how that impacts their deposits and the services that they're getting from their banks. Can you just take a second and give us a quick overview from some of your direct experience with our clients?
Oh, sure, absolutely, Tony. I think in the last, I would say maybe a year ago when we had this conversation about corporate treasury and their awareness around Basel III, I think the trend was, it's not really affecting me yet. I'll wait for the banks to tell me what I need to do. There wasn't as much of a sense of urgency as we're seeing now, and there wasn't as much of a sense of, what do I need to do next? And I think that what we're seeing, if we go back and look at the trends, which we don't need to do, but I'll just bring it up, I think when we're seeing more frequency of mention around issues related to bank relationship management and banking liquidity structure, I think that may be a driver. As corporate treasurers are talking to their banks, they're receiving more and more information that's actually visceral to them, that they're actually realizing, oh, I need to really think about this in a very logical and sensible way about what my operating and non-operating deposits are and how that becomes more attractive to my banking partners. And they're still receiving somewhat conflicting information, but I think now it's becoming much more top of mind that the regulatory environment that's impacting their banking partners is flowing down to them now.
Well, and in fact, to put a fine point on that, just last week, the U.S. Treasury announced some rules about intercompany transfers of cash that were basically designed to scuttle the Pfizer inversion and move to Ireland, but in fact will impact probably half of all large corporate treasuries around the world. And in fact, we're kind of getting early hints that the White House is reconsidering that particular rule. But it just points to the interconnectedness of all of this. I'd like to move over to the card on the left under economic policy. I mean, obviously we could talk all day on these topics, but the topic of negative interest rates, is real in some jurisdictions and is fodder for the editorial pages and the news pages in others. Let's start with Sue again. How do you see negative interest rates impacting corporate investors, and how have they impacted you?
Sure, Tony. I'll actually, take the U.S. view here with respect to negative rates. There've been, many articles in various media outlets over the past couple of months about the prospect for the Federal Reserve to adopt a negative rate interest rate policy or monetary policy, similar as has been done in Japan and elsewhere. And I think largely from our perspective, what sparked that, all of the fuss here really has had to do with the inclusion of negative interest rate scenarios in bank stress testing, or the requirement to include negative interest rate scenarios in bank stress testing by the Federal Reserve. And that set off a firestorm and much speculation as to whether the Fed should move down the same path as under other central banks. Janet Yellen, I think, has fairly effectively downplayed that prospect by saying that it is something that the Fed needs to consider, and they have, in fact, done so over a few times over the past handful of years. But that it's not, I think, not an action that she views as being imminent, and there are also some questions about the effectiveness within the United States model. I think that the prevalence of money market funds, or the dominance of money market funds in the U.S. economy, I think in the U.S. short-term markets, leads to a different outcome than necessarily in other countries. So from our perspective, what really has taken up our time is explaining to shareholders why we don't feel like this is a threat to our products within the near term.
So if you were describing the U.S. view, let's turn to Peter to describe the UK and Eurozone view. What's the view on the negative interest rates there? They are negative.
I think there's a couple of things to mention here. One is the general impact of negative interest rates. For example, we're seeing some impacts in loan agreements and in swap agreements that banks are suggesting that there need to be zero floors, although there are no statutory reasons for that. There are some discussions going on between corporates and banks about zero floors. In the investment markets, we've certainly seen some questions come up in terms of repo markets that, and bear with me, this is a bit convoluted, that if I'm lending you money and you're giving me collateral, but all of a sudden there's a negative interest rate attached, do you give me less collateral, or do I lend you more money to compensate for the lack of interest? How does that work? Because that just increases the credit risk, which would probably mean that I need a bit more collateral or something. So there are some difficult questions to be had there. I think across the board, corporates for the moment are generally avoiding the negative interest rate issue because they're either finding ways of getting additional value by putting their money with banks on longer term, so 100+ day type accounts, or they are finding through some of the money market funds are paying, even if it's very modest amounts, just to keep their heads above water, or even at zero. We've had some debates and some events that we've run recently as to whether people think it's a price for security in much the same way that you pay an insurance premium. And so if it was looked at in those terms, you might even consider it an expense in the way that an insurance premium is, as opposed to an interest receivable, even if it was a negative one. So there may be some other ways in which people can look at this. I think there are other considerations that have come up in all sorts of ways about people even talking, for example, about abolishing cash, because of course negative interest rates might induce people to take money out of the bank, stick it underneath their mattress or bury it at the bottom of the garden, and leave cash in the system, which obviously means it's rather more difficult for central banks to keep control of balances, and they can't impose various ways of using reserve positions with central banks to control what banks are doing in terms of either lending or not lending. It's a confused picture, I think. We're not being overwhelmed, though, with people saying this is dreadful, how do we get around this problem? I think there's a certain element of resignation to, if it's there, we'll deal with it and we'll find a way around the problem. Maybe we can offset it against other charges, for example, as has been the way traditionally in the US with banking relationships between corporates and banks in terms of charges. It's a little bit too difficult to be specific, I don't think, and we're not getting a great deal of people coming and bemoaning negative interest rates with us yet. Just to take out Roger's other point, Kevin's other point, we have been banging the drum about the impact of a great deal of this financial regulation having a direct or even a material indirect impact on corporates for some time. I would absolutely take his point that there is a rising tide of disillusionment, but also a certain amount of, as I say, resignation. But the knowledge is getting out there, but by no means entirely. There are lots and lots of people out there in corporate world, particularly in the M and SM sectors, who don't really have an idea of what's happening. And I'm not sure that their banks or their governments or their central banks or central finance treasuries in governments are telling them a great deal about why this thing is happening to them.
That would presume that the regulators know why this is happening to them.
That's a discussion for a different day and a different location, I suspect.
Probably a good bottle of red wine, too. Yeah.
Well, yes, there's something to be said for that as well.
Yes. Okay. So, Roger, at Fitch, you're rating organizations that are either impacted by interest rates or may be impacted in the not-too-distant future. How are you looking at this issue?
Well, in terms of, the ratings on the companies, I think it impacts them on both sides of the balance sheet in terms of companies that are holding large amounts of cash. Obviously in an environment of near zero or even negative interest rates, the earnings power of that cash and its ability to offset interest costs is impacted. On the other side of the balance sheet, I think, if you go back to sort of fundamental financial theory, we're in an environment right now where even if nominal rates are still modestly positive, through much of the developed world, real interest rates are negative. So, you know, sort of basic financial theory suggests that that's a time when corporations should be issuing more debt, and so, you know, as a rating agency, that is a focus of concern for us, that their debt metrics don't get out of hand, and that their debt service capacity remains intact. So I think it hits, you know, it hits the balance sheet on both the left and the right hand side.
Excellent. I want to go back to Peter, because in a conversation a few days ago, you were talking about the debt service capacity and how some alarm bells are going off, particularly in the high yield or high leverage market. Do you want to take a second and comment on that?
Yeah, I think you saw that I sent you some research that I saw. I can't remember from which source. My apologies for that. Suggesting that precisely the point that Roger's making there about raising debt, there's an impact, of course, if rates start to improve. There's also an impact, of course, if we go into a deflationary period, because, of course, that does nothing but increase the value of the payback. That's a different question, perhaps. And to the extent that contrast with rising cash balances which aren't earning anything, I think the message seems to be that there is definitely a considerable uncertainty of the ability of the financial services system to function effectively, to function in the way that corporates need it to work. And we're talking here about the real economy activities of trade and exports and those types of issues, whether in goods or services. As much as we're talking here about, as Roger rightly points out, clearly if interest rates double and then double again, debt service capacity is going to be hurt, unless there's a capacity to repay that debt using some of those cash balances, albeit that at the time, if that happened to interest rates, they'd start to earn some value. Now, the question then becomes one from a corporate economic point of view is it worth my while having both sides of the balance sheet, or should I use one to pay down the other? I can clearly see from Roger's point of view, you might tend to ignore to an extent the value of the cash because it is temporal and it might, you know, here today, gone tomorrow, whereas the debt might be longer term if you borrowed 5, 10, 15 years in the fixed income market. I think there's a debate to be had there, and whether or not people are taking exposures in the swap markets as well is less certain or less understood. So again, while we're not seeing people overly concerned, and we are seeing people going, particularly investment-grade corporates, going into the debt capital markets, especially in the high-yield space, there is definitely some concern, and there's definitely been some picking and choosing by investors as to what they will or won't buy. Interestingly, I think it probably plays into Roger's hands. It's coming back perhaps to management capability and sector substance than it is about just the financials or the mathematics of the financials, which is probably a good thing in the round, but it might lead to a few tears before bedtime in some circumstances.
Okay.
May I just add one other comment, too, about the cash? I think one other structural aspect that you have to factor in is, and I think Tony alluded earlier to some of the recent, decisions by the administration to limit tax inversions, which are driven by cash trapped overseas. And so from a ratings perspective, one of the questions we always have to ask is, where is the debt located versus where is the cash located? And can you move that cross jurisdictionally without, triggering a big tax payment? So
it's a different form of structural subordination to a vertical one. This is more of a horizontal issue, isn't it? Which is quite an interesting one. I think more particularly, perhaps maybe for U.S. corporates, because this issue of quote trapped unremitted cash overseas. Interestingly, I think it also plays a little bit towards some of the G20's moves on taxation and whether tax is where the corporate's located or where the business is done. And that could slightly change the balance as well in terms of where cash needs to be to pay bills, as opposed to traditionally you'd want it to be centralized, but that may not be where you're paying those bills, particularly those tax bills. That's one for down the road, I think, but I think Roger's point is well taken about transferability.
Now, Peter, as long as your mic is on, don't turn it off here. We'd be remiss if we didn't go to the bottom right corner and ask you about this vote that's coming up in the UK regarding pulling out of the European Union. What's up with that?
The latest polls, certainly today, and I'd imagine probably over the weekend, would suggest that of those decided, it's neck and neck, and undecideds are not, by definition, yet committed. Two caveats I'd add to that. The polls got the Scottish referendum vote and the last UK general election substantively wrong. So there's every opportunity to be cautious about those. Speaking from the ACT's point of view, we are certainly getting a lot more people interested in what might happen if. There isn't as much information out there that's factual. No one's done it before, so no one can be certain to point to a particular example. And there are arguments on both sides. Just very simply, for example, a great deal of what we've talked already here about financial regulatory environment is G20 driven. So it doesn't matter whether you're in the UK, you're in Canada, or you're in Saudi Arabia. Those standards apply. So Brexit in that context is not necessarily relevant. What may happen in the event of a yes or no, whether that's increasing volatility, hard to be sure. Whether it's would increase it, depending on which way it goes, hard to be sure. I tend to be one because my dad, who was in industry for many, many years, would tell you that sterling has been a depreciating currency for 60 or more years. So a little bit of up and down now doesn't really make a great deal of difference. When you look back at what it might once have been worth and what it's worth today, Brexit doesn't really make a great deal of difference. It's too difficult to call. We're getting to an interesting period of time, though. Our annual conference, which is coming up in the middle of May, I'm sure it's going to be a topic of considerable discussion as to how it affects it. We put out some briefing notes. We know some other people like ICMA, International Capital Markets Association, have put out some briefing notes. Theirs is particularly good, for example. But no one can actually say with any definitive substance, that's going to happen, that's not going to happen, or X and Y will therefore follow. It's too difficult to call, I'm afraid. And I wouldn't want to.
Well, no, well, I'll be watching, and it'll be interesting to see if the polls get this one right or not.
Yeah.
I want to move over to the market dynamics in a couple of minutes that we have left, and I'd like to ask Sue to comment. You know, since you're trading in the markets day in and day out. What are you seeing in terms of liquidity and volatility? What's the condition of the market?
Yeah, so it's a good question, a good topic. You know, it even ties pretty closely in with some of the regulatory changes. So we can hit these all at once, particularly with respect to Basel III and the effect that it's had on our trading counterparts. With that intro, you know, market liquidity is a discussion point at the front end of the yield curve, as well as, you know, all the way out to the long end. If you look most recently, the Treasury Department has issued a request for information on the Treasury market structure, with a good component of it dedicated to questions about market liquidity for Treasury securities and what you know, what has changed in the market since the financial crisis. You know, other markets are sort of plagued by the same sort of questions. I think what we have observed, even at the front end, there are certain days when liquidity is definitely an issue. There are many days of quarter ends or month ends when dealers that, you know, typically may have been active in the markets will certainly withdraw, both in terms of the repo business that we do with them on a regular basis, as well as their willingness to take securities onto their balance sheet in transactions at certain dates. And that's a change, and it is definitely a change for the short end of the market. Versus what we've seen previously. So, the markets I invest in are very liquid and very actively traded, but we've all started to adjust to the understanding that a large trade might take a little bit longer to get done, and that we have to take the constraints that dealers have from a balance sheet perspective into account, particularly at at certain times.
Fantastic. Well, what a great discussion. What a great panel. I'd like to point out to all of our listeners that for most of these topics, we actually have short YouTube videos on our YouTube channel. So, feel free to go into YouTube, search Treasury Strategies, and when our channel comes up, you'll actually see many of these same topics with 5, 10, 15-minute videos just describing them and bringing you up to date. I'd like to thank our panel again and encourage you to contact these experts for any issues that you have. Obviously, contact Treasury Strategies. We'd love to help you on a consulting basis with your Treasury liquidity or payment issues. Sue Hill from Federated Investors, thank you. Roger Merritt from Fitch Ratings. And a special thank you today to Peter Massa. As planned, this will be Peter's last cash briefing. He's passing the baton to Steve Bassaby, also from the Association of Corporate Treasurers, who, like Peter, is a former treasurer himself. And Peter, we're going to miss you, but we wish you all the very best. And Peter assures us that we're in good hands with Steve. So thank you there. Thank you very much. Our next quarterly cash briefing will be 3 months from now, second Thursday of July, I believe, so mark that on your calendars. And again, I'd like to encourage you to visit our panelists' websites and feel free to share with them any questions or thoughts that you have. So once again, thank you very much, and we look forward to seeing you next quarter.